What is fundamental analysis in Forex trading? Fundamental analysis in Forex trading goes beyond examining price charts. It evaluates economic data and news to predict market trends. By analyzing a country's economic health, traders can make informed decisions on currency movements. A currency's strength is tied to the economic health of its country. For example, a strong economy often results in a stronger currency. Key indicators like GDP, CPI, and retail sales are essential in fundamental analysis. Understanding supply and demand dynamics is crucial. It helps traders predict currency movements based on economic data. Combining both fundamental and technical analysis can provide a comprehensive trading strategy. Fundamental analysis gives traders a big-picture view of the factors influencing currency values. This includes economic, social, and political elements that affect a country's financial stability. By examining interest rates, inflation, and other economic indicators, traders can gauge the strength of an economy. These factors directly impact the value of currencies in the global market. Knowing a country's economic health helps traders anticipate market trends. For instance, a high GDP might indicate a stronger currency, attracting more investment to that country. Economic indicators like interest rates reflect borrowing costs and overall economic activity, influencing currency values. Inflation, measured by the Consumer Price Index, CPI, shows price changes and purchasing power. Gross domestic product, GDP, is a vital indicator of a country's economic health and productivity. Employment reports reveal spending habits and economic confidence, affecting currency movements. Fundamental analysis differs from technical analysis, which relies on past price data to predict future trends. Both methods have their strengths and weaknesses, offering unique insights into the market. Technical analysis in Forex trading uses past price and volume data to predict future prices. Traders analyze chart patterns, candlesticks, and various indicators to determine optimal buy or sell points. Technical analysis aims to identify support, resistance, and trends to forecast market movements. It uses tools like stop-loss orders for risk management. However, common use of indicators can sometimes lead to self-fulfilling prophecies. Combining fundamental and technical analysis provides a holistic view of the Forex market. While fundamental analysis focuses on economic indicators, technical analysis examines recent market trends. Using both approaches can lead to more informed trading decisions, balancing the long-term economic outlook with short-term price movements. This combination can reduce the risk of relying solely on one method. Effective Forex trading involves understanding technical, fundamental, and market sentiment analysis. Comparing these aspects helps traders navigate the market more effectively. Fundamental analysis in Forex trading looks at supply and demand, macroeconomics, and geopolitical events. These factors collectively influence currency demand and market movements. The Forex market operates on supply and demand principles, trading around $6.6 trillion daily. Economic indicators like GDP and inflation drive currency demand, while central banks influence supply through their policies. Major central banks, like the Federal Reserve, meet regularly to set economic policies impacting currency values. Economic reports, such as employment numbers and housing data, also play a significant role. Macroeconomic trends and geopolitical events heavily influence currency markets. For example, a country's GDP indicates its economic strength, while CPI measures inflation rates, both affecting currency strength. Global events, including wars or terrorist attacks, can disrupt markets. For instance, gold prices spiked in 2009 due to economic instability, highlighting the need to consider geopolitical tensions in trading strategies. Key economic indicators like GDP and inflation rates are crucial for understanding a country's economy. These metrics help traders assess economic health and currency value. GDP measures a country's total production, providing insights into its economic strength. Continuous GDP growth signals economic expansion, often boosting currency value, while a decline indicates recession risks. Inflation tracks price changes over time using measures like the Consumer Price Index, CPI. Controlled inflation indicates economic stability, while high inflation erodes purchasing power and impacts currency value. Governments monitor inflation to adjust interest rates and control economic conditions. A rising CPI often leads to higher interest rates, strengthening the currency by attracting investors. Central bank policies significantly influence Forex markets. Traders closely watch central banks for clues on economic changes that affect currency prices. Central banks use tools like interest rate decisions, asset purchases, and quantitative easing to stabilize the economy. These measures impact currency values by influencing borrowing costs and money supply. For example, raising interest rates can make a currency more attractive, while lower rates might depreciate it. Traders monitor policies from central banks like the Federal Reserve, ECB, and BOJ for market insights. Interest rates are crucial in determining currency strength. Changes in interest rates can cause market fluctuations and impact financial assets. Central bank interest rate announcements are highly anticipated by Forex traders as they can quickly affect currency values. For instance, a rate change in New Zealand in 2008 resulted in a significant currency movement. Interest rates affect currency values by influencing investor preferences. Higher rates attract investors, boosting currency value, while lower rates can lead to depreciation. Employment data, including non-farm payrolls and unemployment rates, are key indicators of economic health. They help predict currency value changes and inform trading decisions. The Non-Farm Payrolls (NFP) report in the US is a critical monthly release, providing insights into the job market's health. A strong NFP report often strengthens the US dollar, impacting global currencies. Unemployment rates reveal job market stability and economic conditions. Lower unemployment suggests a robust economy, increasing consumer spending and potentially boosting currency value. Traders analyze employment data to anticipate economic trends and make informed Forex trading decisions. Understanding these indicators helps predict currency movements. The trade balance, showing the difference between exports and imports, is essential for assessing a country's economic performance. A positive trade balance indicates strong exports, often strengthening the currency.